Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Khalil Hibri, co-founder and managing partner at Tangible. Khalil, very nice to meet you, at least virtually. Thanks for coming on the show. Looking forward to our conversation.
Hi, Todd. Thanks for having me.
Of course. So, Tangible, you guys sit at kind of the intersection of secondaries, liquidity, technology. When you're thinking about launching the firm, ultimately, what did you see that enabled you to say, hey, we should launch this platform?
Actually, both me and my co-founder, we come from a background in private markets. So I used to work for a private equity fund. He was doing club deals also for private, like in the private equity space. The reason why we started Tangible is the fund that I used to work with, we were raising money from individuals more so than we were from institutional investors. So we were raising money from family offices, ultra high net worth individuals all over the world. And that was the main focus. And after a few vintages of our fund, as we went out to market, some of the LPs that invested in the first vintage were asking for liquidity because the fund was doing really well on paper, but the DPI had been slow to come in. And a couple of us asked if they could sell on the secondary market. So we went out and we tried to find a buyer on the secondary market. For these smaller positions, there wasn't a real market for them. And so in that specific case, the GP ended up buying the stake of the investor that wanted to leave. So one investor, was getting older and wanted to find a solution as kind of like an estate planning solution, but it didn't work out. So the GP had to do it. And so I was thinking, this is not a sustainable practice. You can't just keep buying out people that want out. And so let's see if we can make the secondary market also work for wealth investors. And then the crazy part is that today it's easier to sell a 500 million position on the secondary market than it is to sell a 500K position.
That's crazy.
And that's part of why we were inspired to do this. And especially when you see large platforms and wealth managers really making alts accessible to their clients. With that access, there needs to be a liquidity solution because the same thing happens with institutional investors, and they have a very well-oiled machine when it comes to liquidity. So that's what we did, and we were able to crack that nut. So today we work with over 170 buyers, and most of these buyers are open to acquiring smaller positions. The smallest deal we've done is 7K in residual NAV. So we've on the secondary market.
So given the exit environment or lack of exit environment, I mean, has the conversation around liquidity changed the last few years? And you should know as a former private equity industry participant, has that conversation fundamentally changed?
It has changed. I think you've got two types of let's say three types of sellers. So the types of sellers out there or LPs, they're the very sophisticated LPs that do this as part of a yearly rebalancing exercise.
Yep.
We help them, and our platform allows them to do that, run a cost benefit analysis between selling and reinvesting the proceeds versus holding the fund to maturity. And if they can get a higher return by selling and reinvesting, then they do that as part of active portfolio management. So like this active portfolio managers is one category.
Yep.
The other category are people who may have over allocated to a GP, to a vintage, who for some personal circumstance are interested in getting distributions early. Let's say they and that's kind of the group that makes up, I would say, half of our clients. So reduce exposure to a vintage, to a GP, to a strategy. Maybe they over allocated to venture, maybe they over allocated to credit. And so there's that group. And then there's the final group is where just clients that are just bored of being in a fund for over 10 years, where they're tired of filing the K1s. They've been in a fund for this fund has been extended 2 times, 3 times, and they're saying, okay, this is an eyesore. I just want to get it off my books.
So, what are some of the main reasons other than I just want to get off this, get it off the books? Is there any particular thing that's driving this increased demand, especially amongst, say, wealth clients versus institutions? Because institutions have been doing this for a long time, as you referenced.
Funds distributed through wealth have only been distributed through wealth for a short period of time. This is very natural. Like if you think about like how long iCapital's been out there, how long all of these other platforms have been out there, or how long you've been able to access these funds through your wealth manager or RIA, it's been around a decade, let's say. And if you've invested in a fund like early on now, and there's still some TVPI in that fund, and you want to get out, this is actually the moment. So in a way, the secondary market now is emerging because the demand is increasing because the funds have aged, and because DPI, obviously, this kind of DPI gap that we're seeing, that everybody in the market's been seeing, let's say for the last 4 years, is also driving it. So there's like the age of the funds and the fact that there are fewer exits that are happening.
So you guys recently announced, and I think this was the reason I reached out to you in the first place, was the personal NAV loan product. What was kind of your thinking behind that? Maybe just tell us a little bit more about exactly what the product is.
So it's the same philosophy that we have on the secondary side. So if you're investing as an LP and you want to explore selling or like obtaining liquidity, there are 2 ways to do it. One is through a secondary sale, and the other is a NAV loan. A secondary sale is, you get it off your books, but a NAV loan, if the rate makes sense and is good enough, you can actually get the liquidity that you want without having to sell the assets. And the real key there is making sure that the pricing actually makes sense, because if you're paying very high pricing, then you should not do it, or it doesn't make sense. Yeah. So, and our main challenge has been to get the market to also take the wealth clients as an interesting borrower base. So the fund finance industry is growing really fast, just like the secondaries industry, but it primarily caters to people who want to borrow 50 million and above. Yeah. So it caters to GPs, to fund of funds, to large institutional LPs that have very diversified and very large portfolios. If you have the same exact portfolio but smaller, you get access to much higher rates. Like the difference is around 800 bips sometimes if you're borrowing a small amount versus a larger amount. And so that's what we've been trying to do, is reach out to all the lenders out there, get everybody in the market to also take advantage of this opportunity, and provide the borrowers, so the LPs, with rates that are as competitive as the institutions get. So that's our main the effort that we've been doing for the last year on the NAV lending side.
Practically speaking, like at an operational or technology level, it's what does the infrastructure look like, or has
Yeah,
the infrastructure needed to be created for loans of this scale versus, the ones that you've referenced, 50 million or above?
totally. Because just like on the secondary side, we've standardized all the loan documentation, the loan agreements, the pledge agreements, and you need infrastructure for loan servicing in order to get this to take off in a big way. If you're going to have negotiated agreements back and forth, and then lawyers also involved, lots of committees, it's not going to work because if you're doing a very large deal, then you can absorb those legal costs and all that back
Yeah.
and forth. If you're doing a smaller deal, you can't. So for scale, we've standardized the entire closing process and the loan administration process. The other thing that we've standardized, um, actually, it's not something that we've standardized. We've created this. So the interesting thing part in both secondaries and on the lending side is discovery. Does it make an analysis? Does it make sense for me to sell? Does it make sense for me to borrow? How does each scenario compare to holding? Should I sell or should I borrow?
Yeah.
All of these questions are not easily answered unless you have, an analyst working on them. So that capability, we've created a user interface where clients could actually run all of these different analyses so that they can make decisions properly and so that they can review offers properly. So that's what we offer them. That nobody has, not the institutions don't have this either. We've created this just to make it a better user experience for everybody. And then we've standardized the loan closing and then the loan servicing and management. And the pledges, the liens, all of that is very important also for borrowers, for lenders to get comfortable and to decrease the rates as much as possible.
Are you getting a sense, or do you even have insight into, what they're using some of the funds for? Is it, tax planning, reinvestment, anything else particularly interesting that they're looking for liquidity for?
So it's two groups. One are the optimizers. So these are people who come from a private equity background or from a sophisticated finance background,
Yeah.
and they see leverage as a tool to optimize returns. So there's that group, very sophisticated. They just want the ability to, crunch numbers and get a higher return, like increase IRR, basically. And the other group, we don't know. So some of them are using it because, actually, let's say they're used to getting securities-backed loans, so like on their liquid assets.
Yeah.
And let's say you're used to, as part of kind of your general course of business, knowing that you can borrow, 20, 30% against your liquid assets. But then as your alternatives start becoming a larger part of your portfolio, and then you can't access the same kind of leverage against that, then you start thinking, should I continue allocating to alternatives? So having access to that leverage helps you have a more balanced portfolio. And because you can now allocate to alternatives and liquid assets without having to worry about, oh, I can borrow against these, but not against the other group. So we've solved that for them. And if they want to use it because they want for tax purposes, to put up a down payment on a house or, kids going to college. So that's kind of the questions that we're getting.
What about the types of funds? Is it just private equity funds? What about private credit funds? You've referenced venture. Like, are you seeing investors in these particular funds looking for this liquidity, or is it just
Yeah.
focused on private equity and venture?
On the NAV lending or on the secondary side or both?
I guess both, in terms
Yeah.
of this type of product.
So we've done every strategy under the sun. We've done venture growth, pre-IPO companies, funds, fund of funds, feeder funds, tail end funds, more recent funds. So really everything out there, we have a set of buyers for, and it can get competitive regardless of the size or the strategy. So on the secondary side, because of how mature the secondary market has become, you have
Yeah.
buyers for every single kind of strategy, vintage asset. Where you struggle a little bit is when funds are, if it's a drawdown vehicle, where a very small part of the capital has been actually called. So let's say if it's only 20% of the capital has been called, that makes it more of a late stage primary versus a secondary. And the traditional secondary market doesn't like that. What we've done is we've gotten family offices to be more active as buyers. And so there are a lot of family offices that are interested in these funds, not just because they're trying to hit a secondary type return. They just missed out on this fund when it was out in the primary market. So that buyer base is growing, and it's going to be very interesting to see how they compete with the traditional secondary investors, because they have they don't need to generate an IRR hurdle for their investors. They are the end investor. So they should be able to price much more competitively. On the NAV lending side, the rates and the price of the loans depends on what's in the portfolio. So if this is diversified, the more diversification, the better. If there's buyout, credit, infra, venture, everything in there, the more types and the more strategies and number of lines, the better it is. So what we're able to do is show clients that the more funds or positions they add into the collateral pool, the lower the rate goes. And that's the way to approach it. When you have loans, however, that's not always the case. Like some clients just have exposure to a lot of venture or just have exposure to a single company. So we have company founders that have exposure to like the stock that they own, and that's where their wealth is. There, the rates become higher, but there's still a pool of lenders that's able to cater to them. But the rates are much higher than kind of the very diversified portfolios.
Well, that was my next question. Like, what does the pool of lenders look like? Is it non-bank? Are there any banks that are willing to
Yes.
play in this pool?
So we have bank lenders, we have non-bank lenders like private credit funds, we have insurance-backed players, so like insurance-backed SMAs or funds that manage insurance money, really, all types of lenders. And some are interested in only lending against evergreens. Some are only interested in lending against closed-ended funds. Some don't care. Some would lend against very concentrated positions. Some would never come close to that. So it's really diverse because you have different client requests that are coming in. We work with a lot of RIAs, and their clients there's not one specific category of clients. Like not every client is the same.
Yeah.
Yeah.
How big is this market? And then, second, do you see the evolution of this essentially getting to, what securities-backed lending looks like today?
100%. It's going to be as easy as security-backed lending. That's the aim. It's going to be a bit harder to do that because the infrastructure for securities-backed lending on the custody side and on the pledging side is so easy to do at this point. Whereas if you're borrowing against an alternative fund, you need GP approval sometimes, most of the times, in order to put a pledge on the asset. It's not, you need the GP's collaboration, and then it's not just the GP has a fund admin, the custodian, and then so we need all of these parties to collaborate. And as it matures, everybody will be much more comfortable. I think that you have to think of it as a percentage in terms of size. You have to think of it as a percentage of how much AUM has been raised in the wealth space, right? So assuming there's more than $1 trillion that's been raised on the wealth side, you have to assume at least 5% of these people would want liquidity on an annual basis. And, I think it's going to be half NAV lending, half secondary sales. There's no reason for the NAV lending market to be not as large as the secondary market.
Where do you, obviously, NAV lending has never been the most understood, and there's certainly been some misconceptions about it. I know ILPA has put out guidance on it. I had someone from ILPA on the podcast a while back as well. Where do you think the market still misunderstands the product?
ILPA is great, by the way. We love ILPA. We sponsor all their events. We think they're a fantastic organization. And I think one of the things that they've done, which is important, is kind of demystify certain things. I don't know if you saw what they wrote on the legal fees that have been passed on to the LPs from GPs. Like that's amazing stuff that, if they say it, then the
Yeah.
GPs listen. And I think the more they say things, like their voice is very much needed in the industry. So that's one. Two, I think that NAV lending should be, especially when we're talking about the wealth side, it should be used in moderation and in a way like it should be used very little by an LP, right? So if you have a diversified portfolio and you want to get 20, 30% loan to value, that's where it makes sense against your diversified pool of funding when these funds have been mostly called, if they're drawdown vehicles, or if they're used for optimization. We would not, on our platform, we're not going to let borrowers borrow more than that level because then it becomes, and also lenders would not be comfortable lending
Yeah.
either. And what nobody wants in neither the lender, neither the borrower, the bank, the GP, nobody wants a default situation. Fortunately, if they do have a default situation, which is very unlikely, and we haven't seen it yet, we have a secondary market, which is something that a lot of the other NAV lenders don't have. So even on the institutional side, so they don't have a plan in case of a default. They would have to go hire a secondary advisor, find a secondary market for it, find a buyer, and that process takes time. With Tangible, because we have an embedded secondary market within the same quarter, you could have sold the position, paid back the loan, and then returned the rest of the proceeds to the borrower. So I think it's important that it's used very lightly and in moderation, which is the way we've designed it to be done.
I mean, is there a concern that, the certain players will crop up in the market and then it's used in a negative way, or you think,
I don't think so because we get to decide who actually is able to offer the lending solutions on our platform. So, and there's several players that we've spoken to that it doesn't make sense because either the guarantees that they ask for are too high or the rates that they ask for are too high. We want the rates to be as institutional as possible and the conditions to be the same. Otherwise, we wouldn't even provide that option to clients. And clients won't take it because, it's very easy to run the numbers.
if we
But
step,
sorry, and then also
yeah,
we only work with like institutional lenders, so whether it's a bank or private credit fund. So they have they have very strict collateral diversification conditions. They typically are, investing from either their balance sheet of equity or a credit line that they've negotiated. So everybody has to respect very strict rules. Yeah.
So if we step back a little bit, obviously you've referenced secondaries many times during this conversation. What are some of the kind of the bigger shifts you're seeing in the secondaries market today?
I think definitely the maturing of the secondary market. Every week we have a new player that's onboarded. Every week we see a new strategy, more commercial. We've even worked with a buyer that wants to buy secondaries of secondary funds. So it's tertiaries, they're calling it. Like you have, now a strategy for every strategy, right?
Yeah.
So secondary strategy for every primary strategy. That's great. The more buyers there are, the better, because that's good for LPs. The pricing gets better. So that's one of the things that we love. I think in certain strategies, you see a flight to quality. So on the venture side, you see, because of what's happening with AI and like the AI names out there, you see that a lot of the venture funds with a lot of exposure to software, as you know, they're getting higher discounts than they were, 6 months ago because buyers are very cautious and they only want, like sure things. And so their pricing goes a lot more aggressively. I think one thing that's very interesting that we experienced on the market is, with all of what's going on with private credit today, you would think that there would not be an appetite to buy private credit secondaries in these evergreen funds. We were blown away by how much appetite there is and how good the pricing is. And
Hmm.
private credit secondary funds are so eager, and they're providing very competitive rates for these evergreen funds if they do become available. And much higher than what you've seen in the news. And so I think that was a big validation for what we're doing, because one of the things that we do is we create competitive pressure between buyers. We have them compete with one another, and from a best execution perspective, you're getting the best price on the market. If somebody just goes out, and issues a press release and saying, I'm happy to buy this fund at so and so price, the LPs don't know if they're getting the right price. And so our
Yeah.
platform makes them compete with one another. And then the only price is, so the LP has the ability to select the price that actually makes the most sense. And, the interesting thing is that a lot of these funds that are facing redemption pressure and putting redemption caps, on the secondary market, the appetite to buy them is close to par in terms of value.
So clearly there's a disconnect between what the headlines are and what the reality of the market is. And that's, been a common theme that we've covered at this podcast and at some of our events. It's like, hey, here's some bad things about private credit. Meanwhile, the term private credit is certainly broadened well beyond direct lending these days. And the reality of
Yeah.
the market is, a lot different, which is seemingly similar to what you're saying right now.
And I think what LPs need is a choice. They need to have the ability to say, okay, if I can't redeem, but for some reason I need the liquidity or I want it, they should have a secondary market option. And that's what we're working with all the wealth managers and distributors and custodians to allow, is reduce, clear the queue, the redemption queue, reduce the pressure. It's like a release valve. Just allow for secondary market to exist, and then you won't be in the headlines. Like, we're in the headline prevention business
Yeah.
for GPs. And I think GPs now are getting comfortable with the idea that, the fund trading on the secondary market is not something that's bad for them. It's actually validation, because if no one wants to buy your fund on the secondary market, I can guarantee you that's not a good fund. But if a lot of people are willing to
Yeah.
buy it, and the price is just a factor of like time value of money, right? If I'm giving you liquidity today versus you having to wait for it, I should be paid for that, not
Hmm.
me. We're not actually a balance sheet provider, but like, let's say that
Yeah.
the seller is that, okay, if I'm giving you a 10% discount to the NAV, it's because I'm giving you money today. And yeah, that's it.
Obviously, given your technology role, I'm curious how fast do you think we're moving towards a world where private market liquidity is a bit more continuous and tech enabled, market wide than maybe where we are today, which is obviously your platform does it. I don't know if there's others out there, but that sense of like, all right, it's enabled by technology.
So I think here's my prediction, bold prediction, is that do you know the difference between LP led and GP led?
Yeah.
Uh,
I
so
don't
an
know if
LP
everyone in the
led,
audience knows. So
yes.
maybe if you,
So an LP led is when an LP is selling a position on the secondary market. The GP led is when a GP is doing something called a continuation vehicle or kind of a tender offer solution. A GP led is the underwriting. So like buyers, when they look at a GP led, they look at it as, they're doing a lot of underwriting. It's very similar to an M&A transaction. They're underwriting the actual asset or a couple of assets that are in that continuation vehicle. So there's a lot of manual work involved. There's a lot of human creativity and back and forth that's required to get a deal done. If it's an LP position or multiple LP position, actually not using a platform will not make sense in a couple of years. The only way that LP transactions will occur, our thesis is that all LP transactions will occur on a platform, and ours is the leading platform. So like the whole idea is that you need this both for the institutional size deals and the wealth size deals. We're now the wealth side is actually you need it by necessity because you can't do these small transactions unless you use a platform.
Yeah.
But on the institutional side, the efficiency, the optimization, the amount of headache that you can be reduced just by using some technology on price discovery, on running the auction, the deal rooms, having people run different analysis as a buyer or as a seller, and then the transfer and closing process, you can reduce the workload by 80%. Just even on the transfer and closing, the fact that you need to send out to all the GPs, all the list of all the buyers, they need to come back to you and say, I approve or I don't approve. You need to reach out to all the GPs to get transfer forms and then have the buyers and the sellers execute the transfer forms and then send those to the fund admin to execute the transfer, and then it comes back to you, then KYC, AML, like all of that does not need to happen manually. And if it does, it's a disservice to everybody, to the buyer, the seller, the sponsor, and to the team that's running the transaction. So hopefully all LP-led transactions will be done through a platform.
Obviously, it's hard to have a conversation about technology today without mentioning AI.
Yes.
Where do you see AI kind of maybe playing a role in some of this? Does it already today? Does it with your platform?
I think it does a great job when it comes to extracting data from different reporting formats that different GPs use. So there are a lot of compliant solutions out there that help getting data out of quarterly reports, out of capital account statements. That's great. We use on the underwriting side AI and machine learning for our underwriting algorithm that we've developed for ourselves and that we may bring to market soon. And I think that LLMs and like Claude style co-work solutions could play a big role on the closing and settlement part, like the transfer agreement, like filling out a lot of these forms, the KYC, AML. So it just adds efficiency throughout the process, A to Z.
What
And
are
we use it today, and we're very lucky that when we launched this company, it was kind of like just at the beginning, and so we were able to leverage it as much as possible. Yeah.
on the
Just to add
secondary?
on the
Yeah.
AI thing. So where you don't want AI to get involved is anything that has client data, proprietary data that the GPs are providing, anything that is confidential, you have to manage because otherwise, you're getting in like it's a whole different can of worms. So it's important to have very strict segregation of where you use it and where you don't.
In terms of lessons from the institutional secondaries market that can be
Yeah.
applied to the wealth channel, what do you think are some of those?
I think it's very interesting when we have conversations with LPs on the wealth side, let's say family offices. A lot of times when you have conversations, they tell you, oh, but I don't actually need to sell. I don't actually need the liquidity. And in a way, they're worried, what the GP will think or what the wealth manager will, if they decide to actually sell something on the secondary market. So there's kind of a cultural stigma that's there about leveraging the secondary market or, on the lending side. This used to be exactly the case on the institutional side when it first started. It was like you had to say if you had to sell, it's a bad thing, and you're not getting the fair price, and it's like buyers are not fair buyers in terms of how they value these assets. But if you look at it today, the largest pension funds in the world do this every single year. And buyers are competing with each other just to get access to those deals because they're like such high quality deals, and discounts are closing for the high quality assets, and they're trading close to par. So on the wealth side, it should be the same thing. it's like, first of all, this is okay. Nobody needs the liquidity, but if you want it or you want to leverage it, do it. And I think it's not um, out of need, but rather out of preference. And then three, I think the importance of discounts. So people focus more on discount versus opportunity cost. So our job is actually to get market sentiment and to run a proper auction for our clients. We never actually push our clients to sell anything or recommend that they sell it. Our job is to kind of give them all the data so that they can make the right decision. And we're long-term partners for our clients. So we want them to make that right decision. And if we will tell them sometimes pricing has suffered for this type of class vintage or GP this quarter, wait a couple of quarters, let's try again, or it doesn't make sense. What I think the focus should be is not on discounts, but rather opportunity costs. Like what kind of return am I able to generate if I obtain the liquidity today and reinvest it today and compound it versus how much of a discount I'm getting. Because the discount is just optics and about what you're going to do with the money later on that actually matters.
Couple of questions before we get to a couple of fun questions as we come to the end of our conversation here. One is, what areas within fund finance or secondaries are still underbuilt from an infrastructure perspective?
Yeah, I think I'm very curious about things like pref equity and how that could play a bigger role when there's a wider bid-ask spread. So if buyers and sellers have very different pricing expectations, could that become more of a scalable solution? Today, these are heavily negotiated
Yeah.
and there's a lot of back and forth. Um, and I think that that could be really interesting. On the lending side, I think that blockchain could play a big role in the pledging and the lien side of the assets to make sure that, to give lenders comfort that they're actually lending to against an asset that cannot be resold or used as collateral a second time.
Yeah.
I think that we're talking to some players out there that are trying to find solutions, but unless you kind of put the whole fund on the blockchain, could you make sure that only the kind of the pledge part is honored? This is what we're trying to figure out. Like, does it have a role? I think it's probably one of the best real world applications of blockchain technology.
Yep.
And I'm curious to see if that's going to actually work in this case. We're actively trying to make it work.
What final question before the fun ones? What excites you most about this industry, whether it be, the small NAV lending, secondaries, like what excites you most?
I think what excites me is that it does feel like we're still in the early days. So the funny story, when Nate and I, my partner, had the idea to start this business, we were like, okay, let's go to all the secondaries conferences that we can go to. This was like 4 years ago. It wasn't like a long time ago, 3, 4 years ago. And so we signed up to all the secondaries conferences, even fund finance. And you go there and like all the buyers in the secondary market were so excited the first year we went. And they were so excited because they got their own room. The year before and all the years before, they were part of another conference. They were like an add-on conference. They were like a one day of a private credit conference.
Yeah.
And so they were so pleased with themselves that they had matured enough that they had their own room. And now you look at it and how big it has become and how massive. It's still like a very small percentage of the AUM that's actually trading on the secondary market. It's 1 or 2%, which doesn't make sense. And I think you have to think of the secondary market eventually being as large or like a large part of the primary market. So I think that's what excites me the most. And also the fact that wealth investors get exactly the same opportunities and pricing and options as the institutional market. I think with what we're doing and what others that we're working with are doing, we're very close to getting there on all sides.
And shameless plug from my side, we have a fund finance conference and a secondaries conference later this year. So
Yes.
head to our website. Fun questions to wrap up. Favorite sports team and or hobby?
So favorite sports team, I am really bad at sports. I don't know how to play any sports. I don't watch any sports. I'm, I never grew up with team sports around me. So I like to go hiking. I like to do stuff in nature, like hiking, rock climbing. So I don't actually follow. I follow like elections. That's what I'm hooked on. It's like I can tell you,
So that's
how
your
some
sport.
people, yeah, they know sports stats. I know everybody in every election, like municipal, state, in every country in the world. I can tell you who's running and who's winning and who's losing. That's my thing.
Would that be the one surprising thing about yourself?
No, I think the one surprising thing is, so I didn't come from a traditional, most people who work in my industry, they do the traditional path, like they work for an investment bank for a couple of years, and they work on the buy side, then they kind of continue working buy side. Like they either come from consulting or banking. I didn't actually do that. My path has been a bit strange. So I went to college in the US, and then I immediately left afterwards and set up a company in the IT business in Nigeria. And then I worked in West Africa for a few years. And like the coolest project I worked on there was I was working on an aluminum can factory for Coke and Pepsi and beer in a North African country. So basically, did a lot of things where like I had to go to the middle of nowhere and like oversee, like raise money, get permits for like a large industrial project, and had to actually be on the ground doing that. I think that was very formative and very interesting. And I've used a lot of like the knowledge I gained there, getting very complex, dealing with a lot of different regulations, governments, private sector, very slow moving bureaucracy. And that's helped me a lot in my current job because I deal with very large bureaucracies, very large banks and wealth managers.
That's pretty fascinating. One book you'd recommend reading?
I think, one of the other things is that, having lived in Nigeria for a bit, you have amazing authors from West Africa. And I think my favorite book is Half of a Yellow Sun by Chimamanda and Ngozi Adichie. So I'm not going to recommend any business books because I prefer reading fiction to nonfiction. Yeah.
Most exciting part of your job?
Most is all the travel that I do. So I literally I travel almost every week. Like it's a bit tough on the family, but apart from that, it's really cool because, I get to go to every city in Europe, in the US, and in Asia. And it's always really interesting to just, meet with someone over a phone call and then say, oh, you know what, let's meet in person, or I set up it. So I'm going to Singapore now, Hong Kong, plans to go to Tokyo. I was just in New York last week. The week before I was in Miami, Phoenix, wherever. So that got, Zurich, London, Geneva. It's all kinds of fun places.
Well, next time you're in New York, let me know. I'd be happy to have a coffee with you.
Thank you.
And then one prediction, you made an earlier prediction, but what about a prediction for the next 12 months?
I think that my prediction is that this whole private credit redemption thing is going to pass and everybody's going to be fine. I think you're going to have like a few big stories, but overall, I think it's just going to pass and everything's going to be fine. I do think, though, that, and I think on the software side, it's actually worse than we think. So on the credit side, that's very exposed to software, that will suffer, but the general private credit space is fine, in my opinion. But I'm not the expert.
Well, that's a good place to end it. Khalil, thank you very much for your time. Great to meet you, at least virtually, and continued success to you and the team.
Thanks. Take care.
Yep, you too. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.com. dealcatalyst.io. Thanks for listening. Until next time.